policymakers, and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, economists and policymakers expect President Donald Trump's tariffs to slow growth and boost prices. But the scale of the impact, of course, depends on just how the tariffs are implemented. This week, the OECD slashed its outlook for the second time this year, suggesting the world is heading for its weakest growth since a global pandemic. And while Trump has called for rate cuts, Fed officials have signaled they'll hold them steady until they have a better understanding of how tariffs, immigration, and taxes will all affect the U.S. economy. So there's a lot to discuss with Philipp Hildebrand, the vice chair at BlackRock. Philipp, as always, thank you so much for joining us. I think last time we caught up was right before the inauguration. It was actually in Davos, and there we were trying to figure out what kind of presidency or what kind of impact it will have on globalization. We're now at the start of June. What have you learned over the last 6 to 7 weeks?
It's good to be here, Francine. It's been a while. Look, I think generally speaking, it's pretty clear that we're moving from in a sense, a long-standing policy equilibrium to a new one. And we're, I would say, in between. And what is not clear is where this new equilibrium will ultimately settle. And so until that becomes clearer, and the budget that you mentioned at the outset is another indication, until it becomes clear where ultimately the new world will land, as it were, we are in this transition period, and that is a period of volatility, of very rapid news cycles. You know, you wake up every morning and you have more news and you need to digest it and watch you and come here. So I think we need to sort of step back a bit and think about where does the world kind of go to in this clearly new regime that has begun. So
where do you see it going to? But also, is there a danger that, you know, we're going from A to B or A to Z if it's radically different, that a lot of things break in this journey?
I think that is the risk is always when you're in these transition phases that, you know, uncertainty is heightened. Heightened uncertainty tends to weigh on demand. And then on top of it, I think as an overarching theme, you have high debt vulnerability. Most countries, all countries virtually, have come out of the great financial crisis and then COVID, industrial policy. These three big forces have led most countries to accumulate huge debt loads, frankly, and that kind of weighs over the entire system. And you can see that in the sense that rates tend to be edging up. There's a term premium that's beginning to clearly emerge in U.S. bonds. So, you know, all these things are indicators that we are in this volatile and uncertain transition, and we just have to kind of stay fixated on the longer term and see where it all lands.
And Phil, I want to come back to actually the debt in a second. But as a central banker, why have we not seen? So we have very concerning surveys about people being worried, not spending, but it hasn't quite materialized yet. So does that come all at once? Is it a laggard, or could we get away with actually the economy being okay?
Well, it's complicated because number one, if you look at trade policy, we don't know where things will settle.
Right.
And you can see how markets react as soon as there's some pullback of the most extreme scenarios. So that's part of it. The other part is it just takes time. It takes time for these things to settle through. Investment plans don't change overnight. Spending patterns don't change overnight. The U.S. consumer has always been resilient historically. There's also a lot of cash on the sidelines. So if you look at it from an investor's perspective, a lot of incentives to sort of stand ready with the cash and invest when the opportunity comes. So all these forces kind of lead to this slightly uncomfortable interim period, in a sense, between a new equilibrium and the old equilibrium. And it takes time for these things to manifest themselves in the real economy.
So do markets also behave differently because of all of the money in private markets? So
I think that's part of it. You know, there are some great opportunities out there in the marketplace. I was just looking at a statistic the other day. I'm heading to Germany tomorrow. There are apparently 4,000 bridges in Germany that are in urgent need of repair. This is a very kind of basic infrastructure story. Then you think about artificial intelligence. You think about the data centers. the energy supply that will require, the new data centers that will be built. So there is so much, there's so many opportunities, and a lot of them do occur or will occur in private markets, which is one of the reasons we have invested heavily in our private markets capabilities going forward.
Philipp, I want to talk a little bit more about the debt, but also the spat between Elon Musk and Donald Trump. So don't go anywhere. Elon Musk has, of course, blasted the President Trump signature tax bill as budget-busting abomination in a public clash with the U.S. leader following his departure from the administration. So to tell us more a little bit about that, Ross Matheson, our EMEA news director. Ross, this feels significant. How significant is it? Would Donald Trump have taken it really badly?
Well, it's interesting because you saw Elon Musk again up in the wee hours commenting further today, saying again he feels that this bill, this big, beautiful bill, is going to undermine the work that he has been doing or was doing with his Doge cost-cutting effort. So he's obviously feeling this quite personally. He spent a lot of time on this effort, whatever you make of that effort, and it arguably took away from his business. And now he's looking at this big bill and thinking it's going to undo whatever the work was that he thought he was doing. But it's interesting in all the comments, even overnight, calling this bill an abomination, saying that people who voted for it, should be, embarrassed or whatever. He didn't actually say anything directly about Donald Trump in all of that. He was talking to the Republicans who voted for this bill, and a warning shot to Republicans, I guess, in the Senate. And the response from the White House is that Donald Trump knows Elon Musk's position on this and understands that. So they're being really careful, each of them, in terms of not trying to come at the other directly. So Elon Musk being very critical of this bill, and through that, I guess, Donald Trump, but not saying those words directly. And Donald Trump in turn, and I guess the question is why? And really, they kind of need each other still in a way. Donald Trump benefited from Elon Musk during the campaign and his funds. Midterm elections are not that far away. Elon Musk obviously needs his businesses to be thriving in the US economic environment and policies. But can they hold the line is the question. And do they start to really show a greater level of personal animosity in all of this? But for now, they're being really, really careful.
Ross, thank you so much. Ross Matheson there with the very latest, of course, on this Elon Musk spat. Also, the U.S. and China ratcheting up tensions. Philipp, I guess, the concern is about debt. So Elon Musk has ways of doing it which are a little bit unorthodox, going after the president with, pork-filled words. But the bottom line is that he's worried about a debt and that he's cut so much in Doge and that it doesn't go anywhere. How should we view treasuries? Should we start thinking about, is it as safe as it used to be? Does this also change everything?
Yeah, I think this is in a way, the critical question when we talked about the new equilibrium. And again, debt is not an issue just in the U.S. It's an issue in most countries. It's a result of the last 20 years, in a sense. I would say, there are only a handful of countries that have never put in question the sanctity of their sovereign signature, that have never had a sort of outright default. It is extremely important that the U.S. remains firmly in that camp of those handful of countries. The U.S. dollar remains the world's reserve currency. It remains the anchor of the system. The U.S. bond market is the anchor of the financial system. So it is extremely important that Congress, which is deliberating the new budget now, keeps in mind this critical issue of protecting the sanctity of the sovereign signature in the United States as the anchor of the system, notwithstanding whatever changes they want to make to the overall economic order, to the trade order in particular. This question of being able to rely on the sanctity of the sovereign signature in the United States is very, very important.
Philipp, I know Larry Fink also penned a really interesting opinion piece, and this is a quote that we picked out, which is basically the thesis of what he wrote, which is, what's emerging now is globalization's second draft, a re-globalization built not just to generate prosperity, but to aim it towards the people and places left behind in the first time. It's difficult to see exactly where it ends up, given U.S.-China and this fight that keeps on escalating every day, including today. It's difficult to know how it ends up because of AI that will break a lot of things. When does it settle?
Well, I think we can see certain things emerging. And Larry says nicely, it's in some ways easier to look at the 7 years ahead than the 7 days ahead, which I thought was a great line. I would say we we know that this debt issue has to be addressed. I think that's critical. It'll take time. And frankly, the best way to address it is through growth policies. What we have not seen yet, if you think about the sequencing of the new administration in the United States, much of what has come initially has been contractionary, has raised uncertainty, has in some ways led to more volatility in the marketplace. The next leg of it, hopefully at some point, will be the question of what can you do to promote a pro-growth policy. If you recall early on during the campaign, there was much talk about simplification, deregulation, easing up bureaucracy. Things like that can help growth. So there's no question that sustained higher growth would be the best way to deal with the debt and deficit problems in combination with reasonable budgetary policy. And so I think that really is the key to make sure that we can maintain stability around debt. Because with all the other uncertainties that we have, the last thing you want is questions around, again, the sanctity of the sovereign signature. The other thing that you can see emerging, and Larry has been very consistent on this, is the power of capital markets. It is clear that when you have debt levels the way we have them across the world, governments will be constrained in what they can do with public finances. And this is the moment, in a sense, where private capital has to step in. We talked about the large cash balances. This is needed for governments. It's needed for future prosperity. It's a great opportunity.
So do you think, does capital get deployed differently in, globalization 2.0? And is it being redrafted because of allies? So actually, is it geopolitics or is it about the economics?
Well, I think it's a bit of both. Again, we have this fragmentation of geopolitics. The new system will be different than the 80 years that we've known since World War II. There may be more of a home bias in how capital is deployed. I firmly believe that globalization is not over, but it will be reconfigured in a different way. And a stronger home bias may well be part of the way you deal with these fragmented geopolitical conditions. So take Europe as an example. Europe has extraordinary 10 to 11 trillion euros are sitting on bank deposits in Europe. That money sits on bank deposits. It's not entirely idle, of course. Bank balance sheets are being used to support the economy, but it's sitting there in a way that doesn't really generate much of a return. If part of that money can be deployed and mobilized into the capital markets, and that is, of course, one of the key objectives, I think, for Europe, this capital markets union or savings and investment union, if that can happen, you can see enormous growth potential, innovation potential that comes out of that.
When you look at Europe, how confident are you that this is not going to be a wasted opportunity, that Europe sticks together, comes together with more capital solutions and growth? But is there a danger that, I guess, these, even if trade goes back to normal, that there are deeper issues that stay because of what we lived over the last 6 months?
There is always this danger, Francine, and Europe is a very complicated construct that moves in complicated ways.
That's the understatement of the year.
Whenever I explain Europe to my American colleagues, it's a difficult task. However, I would say Europe is now under maximum pressure. This is Europe's moment. This pressure has always generated responses in Europe. If you look at the last time we've seen anything like this was in '89. When the Soviet Union collapsed. And lo and behold, what happened within 4 years, we had the Maastricht Treaty, which set the foundation for the euro. So I very much see this as a similar moment where there is the new world is exerting maximum pressure on Europe. And I think we talked about the capital markets, completing the single market in telecom, in energy, and finance. There are huge opportunities that Europe can rise to and really change the growth outlook and, frankly, also global investors' outlook. They will reallocate to Europe, at least at the margin, if they can see Europe taking these actions that are necessary.
I'm going to put you on the spot. If I give you $5 million today, where do you, given all the uncertainties, maybe let's say it's a 7-year horizon, where do you put that $5 million?
I think infrastructure is in all its kind of dimensions is a clear need that the world has. It's a place where you have stable returns. It's a place where governments can support the mobilization of private capital with the right policies. And I think Europe, if this pressure moment that Europe is under can generate the actions that are required, particularly around the capital markets union, I think Europe is a great opportunity. The world is very long dollars. The dollar will remain the reserve currency. That's not going to change anytime soon. But at the margin, the world has gone very long the U.S. dollar, and at the margin, I think some reallocation to Europe is very likely to occur, particularly if Europe can rise to this unique challenge, frankly, but also unique opportunity that it has given the new geopolitical and financial order.
Philipp, thank you so much. I could speak to you for another 3 hours, so you'll have to come back really soon. Philipp Hildebrand, Vice Chair at BlackRock. Now, coming up, we head to SuperReturn Berlin, the world's largest private equity event, to check in with the head of the European PE at Neuberger Berman. That's next, and this is Bloomberg. The largest opportunity emerging in private credit is investment-grade assets. Well, that's the view of Apollo President Jim Zelter. He spoke to Kriti Gupta at the private capital conference SuperReturn.
We're clearly leaning massively into the investment-grade side of the world of private capital. And I would say also in the past, a lot of the issues you brought up, in the past, historically, private has been risky and illiquid, and public has been safe and liquid. We would really challenge that convention, and we're seeing it more and more on these investment-grade opportunities that we've been a leader and owner of.
And Kriti Gupta joins us now from Berlin with another guest. Hi, Kriti. Good morning. Over to you.
Good morning, Francine. As you said, we are here in Berlin at the SuperReturn conference, where we're trying to navigate what the major investment themes mean for this part of the financial space. We're talking about a tariff exposure. We're talking about people wanting to find some place to park their money amid all of the volatility. And where in this landscape the U.S. versus Europe follows, as we see this massive trend, certainly in the public markets, of American funds going and getting retransitioned and reallocated to Europe. Let's talk about what that means, though, in terms of liquidity, in terms of the capital markets right here in this side of the Atlantic. I'm joined now this morning by Joana Rocha Scaff. She, of course, is at Neuberger Berman and joins me this morning right here in Berlin. Joana, pleasure to have you on the program. Of course, thrilled to have you. Let's talk about this dynamic of these capital markets. 2025 was the year where every major deal was supposed to find its home in the IPO market, in the debt capital markets even as well. That timeline has been pushed back time and time again for the last couple of years. We finally crossed that threshold where private markets aren't considered this kind of scary alternate universe. They're very much part of a traditional portfolio now. Could the capital market delays hinder that?
So it's, obviously absolutely correct what you said. We entered 2025, and generally that was investor sentiment with a very bullish expectation for capital markets activity. We had a benign macro backdrop. GDP growth was positive and certainly quite strong in the US. Inflation getting under control, an expectation that central banks would continue to reduce rates, and that the new incoming administration in the US would somehow facilitate transactions with some deregulation, especially around antitrust measures. And here we are, and the macro backdrop does feel a bit differently. We're seeing deceleration. We get live feeds from some of our portfolio managers around the real state of the economy with real actual data from portfolio companies, and we are seeing a deceleration, meaningful one in the United States. Rates have not come down as fast as expected, and there's increased uncertainty driven by the trade policy. The next big bomb that people are watching is tax policies and potentially a tax war. There's obviously a lot of domestic challenges at the moment in the US, some real pressures being put on institutions that obviously were highly respected, and that is causing enormous anxiety. So we have seen the activity decelerate. And I think investors at the moment are frankly contending themselves that we're perhaps going into the fourth year of muted exit activity in their portfolios. And this is a bit problematic, because if you take a mature private markets, private equity portfolio, you typically would see about 25% of your portfolio being harvested and realizing cash sent to you annually, and that is very precious money that you would also use to fund new investment activities or distributions that you may need. And for the past 3 years, that figure has dropped from the normal 25-ish to 12, 13. And that's very much the trend we're continuing to see in 2025. So that's putting enormous pressure in the system.
Well, when we're talking about that enormous pressure, how are GPs perhaps finding a way around that? If the IPO market isn't as accessible as it was or hopes to be down the line, what's the solution to that in the interim?
I mean, one phenomena you've started to see is just hold on to the assets longer. So the average hold period for unrealized assets has increased to about 6 years on average. And that, I mean, used to be closer to a 4. So first idea is kick the can forward, it will get better. I'm just going to hold on to this company, so beautiful, and we'll continue to grow. Eventually, because of the structural limitations of their own funds, right, you will have to actually sell companies. But the solutions we currently see are a bit more interim solutions. For example, partial stake sales in portfolio companies, because there's a minority investors that are keen, and we, for example, do that ourselves, keen to do what we call midlife co-investing, where we will buy a minority stake in a company, the GP can elongate their ownership period, but crystallize some valuation, crystallize some of the value, validate their valuation. Secondaries, obviously you've seen the volumes last year. We continue to see GPs approach the market increasingly with these GP-led secondary solutions, in which they will provide the optionality for investors to hold or to sell, which is great, and new investors come in. And also hybrid forms of capital, be a bit more on the junior debt or preferred equity side of things. Those are types of solutions that we're seeing as much more popular in the current environment.
So we're talking about a way around that. Very quickly, if I can ask this U.S. versus Europe kind of exceptionalism trade, this reallocation you had talked about earlier, is there absorption risk when it comes to this massive momentum into Europe right now?
So go back 6 months. We entered the U.S., the year in general, very overweight U.S. The expectations for U.S. GDP growth were very strong. I mean, somewhere, depending on which macroeconomists you believe and follow, somewhere around 2.6 to 2.9. And people were generally overweight U.S. and quite bullish in terms of their continued allocations to that market. And let's keep it in mind, it's the largest private equity market, or historically has been in the world, very well established and with a strong history of returns. This instability, the market turbulence, the noise, and it's not just the international issues that are visible here. I mean, people also pay attention to the domestic issues going on in the U.S. Institutions being challenged, as I said, domestic unrest are causing anxiety.
Yeah.
So and frankly, as I mentioned, the tax bill is becoming more and more of a concern.
Yeah.
So what I currently see from European investors and other non-U.S. investors we work very closely with is that they are starting to pause or slow down, at least, their allocations to the U.S., but they want to invest.
I think we have to leave the conversation there. Joana, Rocha, Scaff over at Neuberger Berman joining me here in SuperReturn. Francine.
Kriti, thank you so much. We'll have plenty more on private markets. This is Bloomberg. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Now, U.S. President Donald Trump says China's Xi is, quote, extremely hard to make a deal with, dimming prospects for a call between the two. Metal exporters gird for the worst as 50% U.S. tariffs on steel and aluminium come into effect. The U.K. secures an exemption. Plus, doubling down, Elon Musk describes President Trump's tax bill as a massive pork-filled abomination. Now, in other news, the international settlement house Euroclear says the impact of President Trump's tariffs have been limited so far. Now, settlement activity increased in the first quarter because of market volatility driven by geopolitical uncertainty. The organization settles and clears a wide range of security transactions and has almost 41 trillion euros of assets under custody. Now, they also hold most of Russia's frozen state assets. Well, I'm delighted to be joined by Valerie Urbain, the chief executive of Euroclear. Thank you so much for joining us. I mean, people don't quite understand the scope and the size of Euroclear because you do the things that we shouldn't hear about, that should be smooth playing. It's like the pipeline. Valerie, first of all, are you quite confident that everything is okay in the markets? We've seen massive volatility, but everything seems to have held up.
Well, we always touch wood when we have this kind of question. But yes, clearly, I mean, everything is okay. You know, we are used to manage huge volumes. Fair to say that the recent weeks have seen very impressive volatility. But it's not the first time neither. You know, with COVID, I mean, we have had sufficient crisis, unfortunately, in the past. So we are used to that, and that's our raison d'être. You know, its purpose is really to support this kind of massive volumes activity.
Are you expecting much more volatility? And again, how does it work? If you're expecting about a volatility, do you have to try and change the systems, or do you just work at them, you know, almost like month by month to make sure that they're as strong as possible?
No, we always have, you know, a huge buffer. Because clearly we expect and we have to be there because it's very much at the time of volatility that our clients are expecting us to be there, to be reliable. So we have massive buffer of CPU, and therefore, you know, we are prepared to handle any type of business. Of course, we have then the teams who are also ready to support and to ask to support questions from clients. So that's also from a people perspective. These are moments which are very, you know, active for them, but that's why we are for.
Is there anything that worries you in the markets, in the market functioning, really, in the kind of, again, the pipeline?
I think so far the market is very well reacted, you know, so I wouldn't know. I'm not worried.
Some of the planned announcement about the Savings and Investment Union seems to have been leaked. I mean, do you like what you've seen and heard so far?
Well, you know, I'm very optimistic because I really like to see, you know, the momentum around Savings and Investment Union. The Capital Market Union is something that we have talked about for 10 years with no real progress. I feel now that, you know, there is something different in the sense that we're not only talking about regulation or whatsoever, we are really talking about real economy. We are talking about, you know, bringing investors the savings of the European to support the real economy in Europe, to start supporting startup, innovative companies, scaling them up, you know. So I feel that now it's really a lot more in view of supporting the European autonomy. So there is a political will, there is an economic will behind all of that. There is also a pride of being Europeans. So I feel that this time, if we can make a change, it's now.
And you're confident that it's coming up with this package, that, you know, the markets will be turbocharged by this, that it's not going to be another wasted opportunity?
Well, you know, I think in Europe often we are negative. So we start by looking at the weak points or what doesn't work. So I think we should rather, on the contrary, think that, you know, this is the right time to do it. And this is the moment that we all need to join forces. So, of course, everybody will have to play. The European institutions are coming with their proposal. But the private sector also needs to play its role. And definitely that's what we want to, on our side, we want really to contribute to the development of the SIE.
Does it mean that the clearing industry should potentially also consolidate?
But, I mean, when you talk about consolidation, you know, there is already a consolidation into place. In Euroclear, we represent 62% of the volume in Europe, 51% of the assets in Europe. So there has already been some consolidation. But fair to say that on the equities market, we really need to go further to start offering a more one-stop shop, you know, towards the equities market. We need to look at how we can harmonize market practices, laws, you know, anything we can do to ease access to the equities market.
So what does that look like? Again, because it's difficult. Is it negotiation? Is there low-hanging fruit that actually could let you get there quicker?
Unfortunately, I wouldn't say there are low-hanging fruits. Otherwise, we would have done that, you know. So I think it's a matter of finding also the right support from a regulatory perspective to a fit-for-purpose regulation. I think it's also about, you know, agreeing in every market to think maybe more about Europe rather than national, you know, reality. So, yeah, I think everybody will have to give up a little bit to make it more European and to make it more effective.
Can you talk to us a little bit about private markets? So we've seen a huge rise, actually, in private markets, and I feel like this changes everything in terms of deployment on cash. Does it complicate Euroclear's life? Does it change the transaction landscape in terms of what's on offer to trade and transact?
Well, I would say that it is opening new opportunities because today the private market is not settling through the central securities depository. But fair to say that now that we see the retail market joining as well the private markets, we start engaging with BlackRock, Apollo, iCapital to see how we can address the pain points and come with solutions that we have already used for other type of funds like the ETF, for example. That's a solution that we brought about 10 years ago, where we are offering access to multiple trading platforms, but with one settlement solution. And so we are starting to look with the companies I mentioned how we can create new solutions to reduce the inefficiencies of the markets.
I also want to ask you that, we talk every day about, trade tensions and the fact that globalization may be going through a different phase, but it looks very inward looking, like domestic looking. Yeah. Does that change anything for the clearing industry? Is there a danger that you get caught up in this?
Well, there will be an impact. The financial markets have been pretty globalized. And I think you're right that we are seeing now more and more, pool of liquidity which are being fragmented. Now, having said that, Euroclear's strength has always been to provide interoperability between the different parts of the world. And so clearly there we are again, looking at how we can continue to offer this gateway to the world for the European needs. But also we are seeing with the Asian markets, for example, how we can continue to support their own development with our know-how. So I think, again, whenever there is changes in the market, there are threats, but there are opportunities. And frankly, continuing to see how we can link together the different pools is certainly something that we are looking at.
How do you view currently the debate of using these Russian frozen central bank assets? It seems to be gaining traction.
It's a debate that we have for 3 years, unfortunately. Since the beginning, we are there to execute decisions which have been taken by policymakers. We are also, as practitioners, there to inform them about the potential consequences of any decision that they will be taking. And indeed, the seizing of assets come back and forth. Now, what we always advocate is to think about the stability of the financial market, to think of the attractiveness of the European markets, and linking back to the savings and investment union. You want to make sure that the European markets, the people remain trustful, confident in the European markets, given the gigantic financing need that we have. So, legal certainty, respecting the rules of law, are extremely important, even more so in the context of SIU.
What are the main risks actually for the Euroclear business?
So for Euroclear business, as I say, it's really a loss of confidence in the European markets. If indeed the central banks of the world start feeling that the legal certainty of the European markets can be attacked, that would certainly reduce the attractiveness of euro for them.
And this is actually even more crucial, as people are saying this is the euro's moment to try and get more global weight, given that the dollar is a reserve currency.
Yeah, right? Absolutely right, because I've been touring the world recently, and in November, Europe was a little bit of an anecdote in the Asian markets. Last 2 weeks, I was also in Asia. Now Europe is back again on the agenda. So I think Europe is again an alternative to the US market. It will not replace the US market, but it is an alternative.
But what can Europe do to actually be a real alternative?
Well, continue to develop, to deepen the capital markets. I think this is what is missing. On the fixed income, I think we have a very buoyant market, which is recognized around the world. But on the equities market, I think there are very good companies, but they are not yet sufficiently known. The depth of the market is not strong enough.
Valerie, thank you so much for joining us. Valerie Urbain, the chief executive of Euroclear. Now to some other stories making news today. In South Korea's main index jumped by over 2% after Lee Jae-myung's presidential election win lifted sentiment, pushing the Kospi into a bull market. Now South Korea's new president has pledged to revive economic momentum following 6 months of political chaos spurred by his predecessor's martial law declaration. Now to the Netherlands, where the Dutch Prime Minister Dick Schoof has tendered his resignation and assumed a caretaker role. This after the government collapsed when far-right lawmaker Geert Wilders pulled his Freedom Party out of the ruling coalition, while the outgoing PM criticized the withdrawal.
De afgelopen dagen In recent days, I have repeatedly informed all four party leaders that, in my opinion, the fall of the cabinet was unnecessary and irresponsible. We face significant national and international challenges, and decisiveness is required more than ever. This is crucial for the security of our resilience and the economy in a rapidly changing world.
Well, the White House says President Trump will attend the upcoming NATO summit at The Hague. Now, this comes as Trump steps up pressure on alliance members to increase defense spending. Separately, Bloomberg understands that NATO is asking European members for a five-fold jump in ground-based air defense capabilities to counter Russian aggression. Now, Bloomberg has learned that UK Prime Minister Keir Starmer is considering a Ministry of Defence request to back NATO's proposed new military spend target of 3.5% of national output by 2032. Now, if accepted, it would be a major test of the UK's already stretched public finances. Well, we're now joined by Caroline Hebker, who's been digging into the cost of rearming the UK. Caroline, so good to have you with us on the Pulse. So does the UK actually have the scope to do this? Does it have the money to commit to more defence spending?
Well, at the moment, we're spending 2.3% of our whole economic output on defence. The government has committed to 2.5% with an ambition to go to 3%. The thing is, Britain is now under increased pressure. In a few weeks' time, there'll be the NATO summit. The Ministry of Defence wants the government to commit to more. But our own deep dive, speaking to a whole host of defence contractors, to think tanks and to people who've actually run the British military in terms of the Navy and the armed forces, is that there is a huge gap to make up. Our own Bloomberg economics analysis says trying to reach that NATO goal of 5% would mean £350 billion in terms of costs. So there is an absolutely enormous issue for Britain about how we make up for decades of cuts to our defence and now bolster military spending.
So, Caroline, you've also been speaking to the chairman of Airbus Defence and Space UK. So let's take a listen to that. Don't know if we have it or we don't, but basically, what has he been telling you?
Yeah, so Ben Bridge was in the radio studio to speak to us for this special UK Defence podcast that we've done at length, talking effectively about how he's got 3,500 people in the UK. He is ready to invest more, but only effectively if he gets a contract. And that's the same sort of message that we got from BAE Systems, which is the largest defence contractor here in the UK, from Leonardo UK, which is the big Italian defence contractor, again, that has a big aerospace business in Britain. So the issue is not just for the so-called primes, the big defence contractors, but also for the SMEs. Everybody's waiting to see whether there will actually be money committed to this or not.
Yeah, and how quickly. Caroline, great reporting. I know you can follow all of course, our number analysis and Caroline's great in-depth look at the defence spending on the terminal, on our website, and we'll push it out on social media as well. As always, thank you, Caroline Hebker. Now, coming up, we hear from the EY Chief Executive on what it takes for a business to succeed in today's ever-changing world. That's next, and this is Bloomberg. Well, just half of the businesses surveyed by accounting firm EY say their approach to risks from technology are sufficient, while nearly a third of C-suite leaders say their organization have fully integrated and scaled artificial intelligence. Now, the findings come as EY celebrates its 25th annual Entrepreneur of the Year award, with AI, of course, a key theme for many of the finalists. Well, on this, I'm delighted to be joined by EY's Chief Executive, Janet Truncale. Janet, as always, thank you so much for joining us. So when you took over EY, you're basically a year into the role. There's, a lot to deal with. Are you happy, first of all, with the current structure? Anything you'd like to do differently? How are you servicing your clients?
No, first of all, it's great to be joining you here from Monaco, where we're celebrating our 25th anniversary, celebrating entrepreneurs here from across the world. And so, yes, it's an interesting time that we're focusing on right now. But we're advising clients all over the world. I'm seeing CEOs all over the world. And yes, times are uncertain. But in times of uncertainty, we're really seeing our clients and the CEOs focus on the muscle memory that they have. And uncertainty is the new norm. And so we are seeing our clients focusing on transformation that is still top of mind. We're seeing them focusing on growth and the customer, and we're also seeing them focus on cost cutting as well. And I'm really proud to be taking the helm. I've been here for 1 year, and I know with our scale and our breadth and our scope of services, there's nobody with a better footprint to serve our clients during uncertain times, from the core strategy all the way to execution.
EY, Janet, of course, like many of your rivals, is embracing AI, and we talk a lot about AI, especially where you are in Monaco. What are the ways, big and small, in which this technology is changing the way you work? What do you think this will, mean longer term for headcount and operations?
There's a lot to cover there. Now, first of all, when we launched our strategy, we wanted to make sure that technology was underpinning everything that we do. And I think that's critically important. We're focusing on disrupting ourselves. We're focusing on helping our customers disrupt themselves as well, and also making sure that we're using technology for good. 37% of our entrepreneurs that are here with us in Monaco really have AI-focused businesses. That's up from last year, and we fully expect that to be continuing to grow, going forward as we see our entrepreneurs in future programs. But I think it's really important when I think about technology, there's 4 key principles that we come back to when we think about it for ourselves and also when we think about it for our customers. And first and foremost, we have to really look at the business value. Last year, if you ask me, a lot of the focus on technology and AI was about productivity. We've seen a major shift there, and we're seeing focus on growth and new opportunities as well. So I think the business value is really critical. Then I go back to data. That's really important. That's important for us. We have so much data across all of our businesses that we want to be harnessing. And we want to make sure that our clients are focusing data as part of their big strategy around transformation and technology. Some are at the early end, some are very much evolved as it relates to their data strategy. And then I really want to talk about humans at the center. I'm talking to entrepreneurs here over this entire week. And they keep reminding us that with all the technology enhancements and improvements, we still need humans. Humans are there for judgment and to make sure that we're using all of this technology for good. And then lastly, trust. And I think trust is more important than ever. We just launched our Responsible AI survey, and we are reminded that we have to balance the speed to market with the customer and the consumer confidence. And we really need to be making sure that trust is embedded in everything that we do. And when our clients are deploying new technology, that they have the risk framework and the controls around it to make sure that when we release technology, that it can be trusted.
Janet, when you look at, when you talk to entrepreneurs and some of the smaller firms, do they ask more about what to do with AI, or do they worry about the Trump tariffs and trade wars?
So it's interesting. There's all types of conversations happening here in Monaco with our entrepreneurs. First of all, we have winners from all over the globe, small and big companies. I'm really proud to say we have 53 winners coming from 42 jurisdictions around the world. And for the first time, we actually have a winner from the Ukraine. And so we're reminded that in certain times, we have entrepreneurs here that are really demonstrating perseverance and agility. So we're really reminded of that. And they're really coming from all sectors. And so, yes, they're talking about tariffs, they're talking about technology and AI, but there is something that we can all learn from the entrepreneurs that are here with us this week. And that is all about determination and agility. And I'm telling you that I know confidence has been up and down in the C-suite over the last year, but we could all take a lesson from the entrepreneurs that are here with us in Monaco, because their confidence is really admirable and inspirational.
I mean, but at the same time, we have a lot of chief executives saying it's easier to see what happens in 7 years rather than in 7 days. So what's your best piece of advice for some of these entrepreneurs to keep cool and keep their head down? Is there a magic secret sauce?
I wish there was, Francine. And look, I say all the time, I don't want to, over pivot, under pivot. We need to really remain steady. And I think, lessons that I've learned over the last year, lessons for all of our entrepreneurs and for all of our clients, is to stay the course. Remember that muscle memory. Uncertainty is going to be the norm. It's going to be there for some time. And go back to what you know and make sure that you don't go it alone. we've been talking to a lot of entrepreneurs who got to this point of their business without taking outside capital, without outside advice. And I think it's really important in our strategy and for all of our customers, you don't need to go it alone. With technology, there are broader ecosystems, there are alliance partners that really can help you transform your business to make sure that you're here to stay and that you come out of this time even with a stronger business going forward.
Janet, look, consulting firms, certainly have had a tougher time than the heydays back in 2021, 2022. What does it take for actually customers to want to come back and you see a concrete rebound in your services? Is it more predictability from the U.S. in terms of policy and regulation trajectory that would help you win more business?
Look, we have such a diverse business across, our foundational businesses like audit and tax and risk management, and then to new and emerging areas. We just launched relaunched the EY Parthenon brand that really talks about strategy from the tip of the spear all the way to execution. We've got the #1 brand within transaction tax and transaction diligence. We actually just announced our Studio Plus offering because we're seeing the focus on customer and consumer and that transformational customer experience to be so important and to be a board and C-suite discussion. And so we've got such a balanced portfolio. But of course, we're starting to see the transactions market pick up. We're starting to see, again, more confidence in the system as the tariffs start to settle down. But I'm really confident that we've got such a breadth and scale to our business, that we are very satisfied with where we are, but I see great opportunities and greater growth in the future.
Where would those opportunities and growth come from? Is it different industries? Is it different segmentations or just different markets?
We cover all of our industries. We've seen in this last year that financial services continue to be resilient, industrials and energy. We definitely see a little bit of a mixed bag in the consumer area. But again, I think it goes back to those key principles of focusing on transformation during this time, focus on the consumer. Right now, people have different challenges to deal with. Where are you going to make things? Where are you going to sell things? And I think the consumer experience is going to continue to differentiate our clients in the future. But again, we're seeing really strong growth from financial services, industrial and energy, and a little softer in other areas.
Janet, you have a global mobile workforce. Are you going to redeploy staff? Do staff want to move from certain places to other places?
Oh, absolutely. I think coming out of the pandemic, we saw a greater need and a desire for our younger workforce to travel. And look, we can serve clients all over the globe from anywhere, and that's one of the things that we've learned. And the next generation, we have 5 generations under one roof at EY right now. And I think mobility and career agility more broadly, so not only seeing different parts of the world, but working across sector and across service line is truly going to be a definition and something that the younger workforce is looking for a lot more quickly in their career than maybe folks of my generation did. And I think the firms that can really focus on meeting the needs of that generation where they are will be the winners. I'm reminded all the time, we have 30% of our workforce today is Generation Z. In just 9 years, they will be 70% of our workforce. And they're really going to dictate to us what they want in an employer. And we're really focused on a new employee value proposition that really focuses on learning, development, career agility. And let's not forget wellness. I think that's really going to continue to be a focus of our employee workforce as well.
Janet, so great to speak to you. Thank you so much for making the time. Janet Truncale there, the Chief Executive of EY, speaking to us from the French Riviera. Now, up next, it's a Bloomberg Brief. We look at markets, we look at data, and we look at jobs in the U.S. And this is Bloomberg.